Lithia Motors, ticker LAD on the NYSE. The auto retail company that grew from a single Dodge dealership in Medford, Oregon, to a $35 billion national empire by targeting the markets that AutoNation and Penske didn't want, and is now building a digital retail platform to extend beyond its physical footprint.
Founded in 1946 in Medford, Oregon, still headquartered in Medford, 22,000 employees, fiscal 2024 revenue of $35 billion, finance and insurance revenue per vehicle above $2,100, service revenue of $1.4 billion, the high-margin recurring business that survives vehicle sales cycles.
Walt DeBoer opened the first Lithia Dodge dealership in Medford, Oregon in 1946. The family business stayed local for 4 decades before the third generation, Bryan DeBoer, joined the company in 1985 as a lot porter at age 15, beginning the hands-on apprenticeship that would eventually produce one of the industry's most successful dealership roll-up strategies.
In 1996, Lithia went public on NASDAQ, raising the capital that unlocked the national acquisition strategy. Bryan DeBoer became COO as the public company era began, applying the hands-on operational knowledge from 11 years on dealership lots to the acquisition integration work ahead.
In the 2000s, Lithia formalized the rural market consolidation strategy, deliberately targeting dealerships in smaller markets like Billings, Boise, and Medford that AutoNation and Penske had bypassed in favor of higher-profile metro markets. By 2014, Lithia had passed $5 billion in revenue and was recognized as a national-scale dealer group.
In 2020, COVID-era financial stress created a wave of distressed dealership sellers. Lithia accelerated acquisitions, buying franchises from dealers who needed liquidity, and used the compressed pricing environment to add premium brands and strategic markets at below normal multiples.
In 2021, Lithia launched Driveway.com, a digital vehicle retail platform enabling customers to buy, finance, and schedule home delivery of a vehicle entirely online. That same year, revenue crossed $20 billion. By 2023, Lithia was one of the 3 largest U.S. auto dealer groups by revenue at $36 billion.
Lithia generated $35 billion in fiscal 2024 revenue, down 3% year-over-year as the post-COVID vehicle pricing normalization continued. New vehicles account for 63%, $22 billion. Used vehicles contribute 25%. Finance and insurance adds 8%. Service, body, and parts contributes the remaining 4%.
Finance and insurance revenue per vehicle exceeded $2,100. Warranty products, financing fees, and insurance add-ons that carry 80+% gross margins. This 8% revenue segment generates a disproportionate share of profitability. Driveway digital sales reached 15% of used vehicle transactions, growing steadily.
Lithia's primary moat is rural market density, a geographic strategy that targeted markets where AutoNation and Penske had no presence, lower real estate costs, less competitive intensity, and more durable customer relationships. This rural footprint scores 95 on the competitive radar, the highest single dimension among all peers.
EV service readiness is the second moat, and the forward-looking thesis. 5,000-plus EV-certified technicians across 350-plus locations create a service infrastructure that grows proportionally with the total EV fleet on the road, regardless of which OEM sold the vehicle. A certified EV service bay serves any brand.
Finance and insurance monetization is the third moat. At $2,100 per vehicle in F&I revenue, Lithia captures the highest margin component of the auto retail transaction, and the penetration rate per vehicle is among the best in the industry.
Lithia has delivered 8 consecutive annual dividend increases. Total annual dividends paid approach $55 million. The dividend history from $1 in 2015 to $2 in 2024 reflects 100% growth over the decade.
The dividend at 0.8% yield is modest relative to Lithia's earnings power, reflecting management's preference for capital deployment into acquisitions over dividend payout. The $55 million annual dividend against a $35 billion revenue business illustrates that Lithia's primary capital allocation is reinvestment into dealership network expansion.
On the competitive radar, Lithia leads on acquisition execution at 92 and rural market density at 95, the unique geographic moat. AutoNation leads on digital retail penetration at 82, reflecting its earlier investment in digital tools. Penske leads on EV service readiness at 80, reflecting its luxury brand portfolio's EV exposure.
Lithia scores lowest among peers on EV service readiness at 72, reflecting that its rural market footprint overlaps less with early EV adoption geography than metro-focused peers. Asbury scores 65, even lower. Both are investing to close this gap as EV adoption expands from urban to suburban and rural markets.
Lithia operates 350-plus dealerships across 38-plus U.S. states, plus Canada and the United Kingdom. Over 300,000 vehicles are sold annually. Driveway.com serves all 50 U.S. states digitally. 5,000-plus EV-certified technicians support the service network. 22,000 employees manage the national auto retail operation.
The service revenue business of $1.4 billion is the most durable component of Lithia's model. Customers who buy a vehicle from Lithia return for service regardless of their next vehicle purchase. Service revenue grows as the number of vehicles on the road, the installed base, increases, independent of new vehicle sales cycles.
Bryan DeBoer holds a BA in Business Administration from Southern Oregon University. He joined the family dealership business as a lot porter in 1985 at age 15, spending 11 years in operations before taking the COO role at the time of the 1996 IPO.
DeBoer served as president of Lithia from 2000 through 2012 before becoming president and CEO. His 39-year tenure in the auto retail industry, beginning on the lot before the company was public, gives him an operational depth in dealership economics that most financial industry CEOs cannot replicate. And the rural market strategy he built is the direct output of that ground-level institutional knowledge. Lithia grew from a single Dodge dealership in Medford, Oregon, to a $35 billion auto retail empire in one generation by doing what the major auto groups wouldn't: buying dealerships in Boise and Medford and Billings in markets that Wall Street analysts didn't model. The rural consolidation strategy created a national footprint that now spans 38 states, with dramatically less competitive intensity than the metro markets that AutoNation and Penske concentrated on.
The EV transition is both the risk and the opportunity for Lithia. The risk is that direct-to-consumer Tesla and Rivian models bypass the dealership entirely and compress volumes at the high-growth end of the market. The opportunity is that every EV sold by any brand eventually needs a certified technician, a battery inspection, and a charging system service. And Lithia's network of service bays is the infrastructure for that demand, regardless of which brand sells the vehicle. Lithia Motors reported Q1 2026 GAAP earnings per share of $23.40, but strip out a $393 million after-tax gain from monetizing a stake in Driveway Finance Corporation, and adjusted EPS was $7.34, missing the $8.10 consensus by 9.4%. Revenue of $7.2 billion beat estimates. The headline is noise. The signal is a dealership business under margin pressure and a fintech arm the market has not priced.
Lithia Motors was founded in 1946 as a single Chevrolet dealership in Medford, Oregon. Today it is one of the largest automotive retail groups in North America, operating more than 300 franchise dealerships across the United States and Canada. The company sells new and used vehicles, provides vehicle service and repair, and arranges financing through its captive finance arm, Driveway Finance Corporation. Lithia serves approximately 4 million customers annually through its physical stores and Driveway digital retail platform.
With trailing 12-month revenue of $29 billion, a market cap of $5.34 billion, and approximately 24.5 million shares outstanding, Lithia trades at approximately 7.8 times forward earnings on adjusted EPS. CEO Bryan DeBoer has led the company since 2012 and built Lithia from a regional Pacific Northwest dealer group into a national-scale automotive retail and fintech platform.
Q1 revenue of $7.2 billion beat the $7.05 billion estimate by 2% and grew 4.3% year over year. New vehicle sales accounted for 49% of revenue at $3.5 billion, used vehicles at 29%, $2.1 billion, and service, parts, and finance at the remaining 22%, $1.6 billion.
The number that requires explanation is GAAP net income of $573 million, or $23.40 per share, versus adjusted net income of $180 million, or $7.34 per share. The difference is a $393 million after-tax gain from selling a minority stake in Driveway Finance Corporation to a private equity consortium in March 2026.
The DFC stake implied a Driveway finance valuation of approximately $2.2 billion, 41% of Lithia's current market cap, assigned to a captive lender originated from zero in 2019. DFC now originates approximately $2.8 billion in auto loans annually, growing 32% year over year, with a loan portfolio tilted toward near-prime borrowers at average rates above 9%.
Adjusted EPS of $7.34 missed the $8.10 consensus by 9.4%, the third consecutive quarter of adjusted EPS below consensus. The miss reflects vehicle gross profit per unit compression. New vehicle GPU averaged $3,100 in Q1, down from $3,500 a year ago, as OEM incentive programs pulled back and consumer financing costs remained elevated.
Operating margin contracted to 3.5% from 4% in Q1 2025, 50 basis points of compression. Gross profit margin held at 15.2%, as higher margin service and parts revenue offset the vehicle GPU compression, but the operating line absorbed higher interest expense on the $8.2 billion debt stack, up $62 million year over year.
Free cash flow on a trailing 12-month basis was $620 million. Q1 buybacks totaled $45 million, well below historical pace, as management conserved cash ahead of the DFC transaction. The annual dividend of $1.20 per share, yielding approximately 0.5%, is minimal relative to the balance sheet. Lithia prioritizes acquisition capital over shareholder returns.
Bryan DeBoer joined Lithia Motors as CFO in 1999 and became president and CEO in 2012. Under his 14-year tenure, Lithia expanded from a 40-store Pacific Northwest group to more than 300 stores nationally, completing over 150 acquisitions. DeBoer is also the architect of the Driveway platform, positioning Lithia as a technology-enabled retailer rather than a traditional dealer group.
Consensus sits at 7 buys, 8 holds, and 3 sells, with an average price target of $245, roughly 12% above the current price. The hold-heavy distribution reflects analyst caution on the adjusted EPS miss streak. No analyst upgraded LID in the week following results, with most maintaining ratings while trimming price targets modestly.
JP Morgan maintained overweight with a target of 270, arguing that the DFC stake valuation creates a sum of parts floor for Lithia shares. The core dealership business at 6 times earnings, plus the DFC fintech stub at $2.2 billion, implies intrinsic value well above the current price. The analyst's key concern is timeline. DFC needs to grow its loan book without credit quality deterioration.
Deutsche Bank downgraded to hold from buy, citing the three-quarter AG EPS miss streak as evidence that vehicle margin normalization is not yet complete. The analyst lowered the price target to $225 from $260, noting that at 7.8 times forward earnings, the stock screens cheap, but only if the AG EPS trough is Q1, a claim the data does not yet support.
Bulls focus on the sum of parts story. At 7 times adjusted operating income for the core dealer business, plus the $2.2 billion DFC valuation, Lithia's implied share price is closer to $280 than the current $218. The market is not giving credit for DFC because it is embedded in a dealership income statement. The stake sale forced the first external valuation.
Bears counter that the DFC valuation is venture-style optionality embedded in a cyclical business. If vehicle sales volume contracts 10% on affordability pressure, Lithia's ADJ EPS falls toward $5, and DFC loan losses accelerate in the same macro environment that would drive that vehicle volume decline. The correlation eliminates the diversification benefit.
The bull case is a sum of parts re-rating. Lithia is mispriced because the market values it as a single dealership business when it is actually a dealership group, worth 6 to 7 times earnings. plus a fintech lender worth $2.2 billion that sits off the investor radar embedded in a dealer income statement. The DFC stake sale forced the market to confront the valuation gap.
Service and parts revenue provides a recession-resistant floor. At 15.2% gross margins, Lithia's service department runs 45 to 55% margins. The aging U.S. vehicle fleet means repair demand is inelastic. Even if new vehicle sales decline 20%, service revenue contracts only 5 to 8%, limiting downside to AJ EPS.
At 7.8 times forward AJ EPS, Lithia trades at its lowest multiple since 2019. The last time LAD traded this cheaply, the subsequent two-year return was 93%. If AJ EPS stabilizes at $8 to $9 and the multiple returns to 10 times, the stock is $80 to $90 above current levels.
The bear case starts with the AJ EPS trend. 734 in Q1 after 805, 720, and 734 in the three prior quarters, a declining pattern with no confirmed trough. If vehicle gross profit per unit remains compressed through 2026 as affordability limits new vehicle demand, AJ EPS at 7 is not the floor.
The debt stack is the structural concern. $8.2 billion in total obligations, including vehicle floor plan financing, means that every 100 basis point increase in short-term rates costs Lithia approximately $82 million in additional annual interest expense. At 3.5% operating margins, that is a meaningful earnings headwind that flows directly through to AJ EPS.
DFC credit quality is the hidden risk in the bull case. Driveway Finance originates near-prime auto loans at above 9% average rates, a segment with delinquency sensitivity to employment conditions. The DFC loan book grew 32% in 2025. If delinquencies rise 50 to 100 basis points from current levels, DFC requires capital infusions that offset the valuation gain the PE stake sale established.
EV transition risk is longer dated but real. As OEMs accelerate direct-to-consumer EV sales, bypassing dealer networks, Lithia's franchise value erodes in the highest growth segment. The traditional franchise model faces a structural question that the 7.8 multiple already prices in.
AutoNation is Lithia's most direct comparable, another large national dealership group. AutoNation trades at approximately 8 times forward earnings, a slight premium to Lithia's 7.8 times, reflecting lower leverage and a more conservative balance sheet. AutoNation's decision to exit its used-only AutoNation USA stores reduced revenue but improved margins and investor clarity.
CarMax, the largest used vehicle retailer, trades at 18 times forward earnings, more than double the dealership group multiple. CarMax's premium reflects its captive finance arm, CarMax Auto Finance, which mirrors the DFC thesis at Lithia. The comparison shows what the market pays for a captive lender, cleanly separated from the dealer P&L.
Penske Automotive and Asbury Automotive both trade near 8 to 9 times forward earnings, consistent with the peer group. Penske carries less debt than Lithia and has higher exposure to luxury brands, which sustained gross profit per unit better than volume brands in the 2025 normalization. Asbury's SaaS-enabled online retailing platform is similar in concept to Driveway, though smaller in scale.
The peer set confirms that dealership group multiples are compressed across the board, a sector-wide re-rating on affordability concerns and EV franchise uncertainty. Lithia screens as the cheapest among large-cap peers on an adjusted earnings basis, while carrying the most diversified platform story through DFC. The discount is real. Whether it is deserved is the investor debate.
Options activity pre-earnings reflected unusual uncertainty. The put-call ratio hit 1.4, nearly 3 times the post-earnings read on a typical dealership name, driven by hedging around the gap versus adjusted EPS split. Institutional investors who held through prior quarters were protecting gains. The options market assigned meaningful probability to a sharp downside reaction on the AJ EPS miss.
Post-earnings, September $200 puts saw heavy volume, the largest options flow in Lithia in 18 months. That positioning reflects institutional investors setting downside floors if vehicle margin compression continues. The call side remained muted, with modest premium building only at 250 strikes. Options participants are focused on protection, not participation.
On the insider side, CEO Bryan DeBoer sold 15,000 shares at $224.10 in March 2026, a planned 10b5-1 sale, representing approximately 3.4 million. No officers purchased shares in Q1. At advisory boutiques, insider buys are signal. At cyclical companies, insider sales on 10b5-1 plans carry less weight, but the absence of buying at a multi-year valuation low is worth noting.
The $45 million Q1 buyback was the smallest quarterly repurchase in 2 years, reflecting management's decision to conserve cash around the DFC transaction. With net debt of $6.4 billion and $620 million FCF, Lithia's buyback capacity is constrained. Expect repurchases below $100 million per quarter until vehicle margin recovery improves FCF visibility.
Lithia's Q1 is a tale of two numbers. GAAP 2340 is real money but one time. Adjusted 734 is the business, and it missed for the third consecutive quarter. Cheap at 7.8 times does not cure a pattern of EPS deterioration.
The Driveway thesis is compelling. The DFC stake tells you the market is leaving money on the table. Own it for the fintech story only if EPS stops declining. New vehicle gross profit per unit is the signal.
Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.